Hey guys, it's Anu Joshi, real estate broker. Welcome to my YouTube channel. For those of you who don't know, I am a real estate broker. I work in Toronto and area. I help my clients buy, sell, and invest in real estate. And today's topic is about mortgages. Specifically, we're going to be talking about mortgage terms and mortgage amortization. So a mortgage term basically refers to the amount of time, a contract, if you will, that you have with a bank or with whoever your financial institution is for the term of the mortgage. So how long you're going to stay with them and how long that mortgage product is going to be applicable to the house. So when you hear about people getting a 5-year term or a 2-year term or a 3-year term, what they're talking about is that's the length of the contract that they have for that particular mortgage on that particular property of that particular amount with that particular financial institution. Now, it is a contract in a sense that you have to you owe the bank all the mortgage payments. So whether it's 48 months for 4 years, if it's 60 months, whatever it may be, depending on your term. So that was the distilled water version of what a mortgage term is. Now let's quickly cover mortgage amortization. So amortization is a super big word and it comes from amort, which means death, and mortgage also means death. But we're not going to get into that because I'm not a linguistics expert. Okay, so what does amortization mean? So amortization basically means that your mortgage amount, whatever your loan amount is, it's split over a period of time. So this is not your term. The term is just the contract that you're locked into with your mortgage, right? The amortization is like, for example, if you have a $600,000 mortgage, 600,000 divided by 25 years, which is the amortization, divided by 12 months in a year equals 2,000. So basically, this is very, very simply put. This is not exactly how a mortgage works, but this is the principle. And amortization is the entire period over which all of your mortgage payments are split. If you have $600,000 mortgage split over 25 years, basically what an amortization means is over the course of those 25 years, at the end of the 25, you will have paid off your entire mortgage. So there is an algorithm that says, you know, how much of the monthly portion is principal repayment versus how much is your interest payment. So that 2,000 figure that I just pulled out of nowhere, that's just a ballpark number. So essentially, if you were to pay $2,000 every single month to your financial institution for the entire amortization, which is 25 years, for that entire time, at the end of it, you would have paid off your entire mortgage. That's basically what it means. Now, does the mortgage term have any effect on the amount of monthly payments? And the answer to that is no. So it's just like you don't have to pay it off, right? The payoff period, like you were to pay off a car lease, the payoff period is the entire amortization, the 25 years. The term is just a contract that you're locked into. So you don't have to pay off the entire amount of the mortgage in 5 years. No, you just have to pay 5 years proportionate share of the mortgage payments. Obviously, because at the end of 5 years, you're not going to have a paid off house. At the end of 25 years, though, you will, if you stay on the same terms and everything. Does the mortgage amortization affect your monthly payments? Yes, it does. Okay. The longer the amortization, the lower your monthly payments. Let me say that again. The longer your amortization period, the lower your monthly payments. And the reason for that is simply because the mortgage amount is split over a larger number of months as opposed to a lesser number of months. So if we take the same figure as before, 600,000, and we divided it previously by 25 years, so a 25-year amortization, came out to approximately $2,000 a month. That's the proportionate monthly share. If we did the same thing, if we did 30 years, then that would be $1,666. The proportionate share would be $1,667. So it has decreased by about $340 a month. So obviously, if you're spreading over your mortgage breakdown over a longer period, it will bring them lower, which is a good thing. So we want longer amortizations. Now, for any down payments, BT dubs, 5% down payment, 10%, 15%, you can only maximum qualify for 25-year amortization. The second you hit 20% down payment or greater, you can ask your lender to give you a 30-year amortization. If you're showing more down payment funds, then you can get the benefit of having a longer amortization. Now, recently in the news, there has been some talk about Toronto Real Estate Board actually asking Ontario and actually Canada to increase amortization periods to 40 years. So if 25 years to 30 years can make a difference of about $340 on a $600,000 mortgage, imagine what 25 years to 40 could do to help you shave off about $1,000 off the mortgage payment if we're going by that basic calculation, which would be a huge help, but we don't unfortunately have that yet. So that was the distilled water version of amortization versus mortgage term. If you have any more questions, please reach out to me. I know it's tough in video format, but I'm just trying to do my best to get it out there. If you guys have any more questions, definitely let me know. Post in the comments below, or I am available at Joshi Realty, and I'll post all my social links as well. I love to hear from you guys. Thank you so much for watching my last video, and I hope you enjoyed this one and all the next ones just as much. If you thought this was helpful, please share it with your friends and family and put it on your socials. Tag me at Joshi Realty. I would really appreciate the support, and if you guys could like and subscribe, that would be awesome. I'll see you guys on the next video. Amort or mort or something like that means death in Latin.